Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Ray, and I am a senior investment strategist with the CIO team. A very warm welcome to you through the Noise podcast this week. Earlier this week, we have the inauguration of Trump as the 47th U.S. president, and the market reaction thus far has been very positive. So to us, the question is, shall we expect all smooth sailing going forward? To discuss this more, I am happy to join by Rajat Bhattacharya, Senior Investment Strategist with our CIO team. So Rajat, let me first start with a question. So Donald Trump's first week in the office is seemingly cheered by the market. What do you think from here?
Hi Ray, thanks for having me. I think the verdict has been positive so far. The markets, as you mentioned, have cheered his week one policy statements. Global stocks and bonds rose, for instance, while the US dollar and oil prices fell, as Trump's seemingly softer stance on tariffs against trade partners and his push to boost energy output eased some of those inflation concerns. I must add that a sustained equity rally from here will likely need lower US bond yields, a weaker dollar, and lower oil prices. For that, investors will need to see that Trump's nuanced tariff threats versus China and neighbors Canada and Mexico are aimed at negotiating trade deals, perhaps even involving a weaker US dollar instead of triggering an all out trade war. Now, policy uncertainty notwithstanding, we remain pro risk in our asset allocation with a preference for US equities and high yield bonds, especially with companies on course to deliver yet another quarter of earnings beats, which I'm sure we'll discuss in a bit.
Yeah, thank you, Rajat. Can you tell us a little bit more about what we have gleaned from this initial announcement?
Trump's less hawkish tariff stance, as I mentioned, and his call at the World Economic Forum in Davos for OPEC and Saudi Arabia to boost oil output and central banks to cut rates drove the S&P 500 index to a new record high, lowered bond yields, and dragged the US dollar from its two-year highs. The US Equity Volatility Index, which is also known as VIX, fell, which suggests that the investor concerns have eased after Trump refrained from imposing blanket tariffs against trade partners, which was the prevalent theme heading into this inauguration. Instead, Trump threatened 25% tariffs against Canada and Mexico and 10% tariffs against China by 1st February. And I think that's likely an opening gambit, if you will, for negotiations to reduce the US budget deficit and attract foreign investment. A trade deal, which also involves a pact with trade partners to weaken the dollar, would be significant as it could trigger a revival of non US dollar and emerging markets assets. China will, of course, need to agree to such a deal and appreciate the yuan versus the dollar. At Davos, Trump also said that he would rather not use tariffs on China, which is interesting.
Yeah, surely that is very interesting. And in that case, what do you make of all these in terms of his policy stance going forward?
So, negotiated trade deals to me would imply Trump is heeding the advice of his business friendly Treasury Secretary nominee, Scott Bessent, whose views often contrast with the ideological and hawkish positions of many of other Trump cabinet colleagues. Besant, who's a career fund manager, believes the most prudent and market friendly course for Trump to achieve his non inflationary pro growth agenda would be by raising US potential growth to 3% from below 2% with the help of supply side policies, including tax cuts and deregulation. He believes higher economic growth will help reduce the US budget deficit significantly, from around 6.6% of GDP currently, lowering US borrowing costs. The third element of Besant's so called Three Arrows policy proposal is to significantly boost US energy production, which, besides powering the AI led industrial revolution and putting the US in a leadership position in that sector, will also lower energy costs and, by extension, long term inflation expectations.
Thank you for that. Let's switch gear a little bit. There are going to be Fed and ECB meeting coming up next week. How will the major central banks react in your view?
So we think the Fed is likely to stay on hold next week until we have more clarity on some of Trump's trade, fiscal, immigration, and energy policies. Although Trump signed a raft of executive orders on day one, as we know, and which were widely published, he laid out his policy agenda, and also he laid out policy agenda in Davos. Questions still remain unanswered, and this includes his approach to the upcoming debt ceiling. Remember that the US government will run out of money to pay its debt in the coming months unless the government makes significant spending cuts or raises ceiling. Then he needs to clarify how any spending cuts will align with his tax cut plan and whether the proposed immigration curbs that he's announced will be tempered. Now, Trump's success in reviving US energy sector investment to boost output and lower energy prices, which is a big part of his agenda, remains uncertain because US drilling rig count has fallen to 3 year lows despite all those announcements. However, we think the ECB is likely to cut rates next week while the Fed holds rates because there is growing risk that the European economy is slowing and they need to do something about it.
Yeah. I think there are continue to be more risk events that we need to watch out for. Let's move on to the U.S. quarter four earnings for 2024. Um, how had the earnings season fared so far, and what are your expectations for the high growth sector in particular?
Yes, you're right that against this uncertain policy backdrop that I talked about, we do expect US corporate earnings surprises to provide fundamental support for US equity outperformance this year. To your question on how US earnings are faring, they've been pretty resilient. So as of 23rd January, about 15% companies in the S&P 500 index have reported earnings so far. So it's still early in early days, but within that, overall growth has been around 18% year on year, according to Bloomberg estimates. Now, communication services and technology sectors have been the leaders in this earnings season, while materials, consumer discretionary, and healthcare lagged. Looking forward, we anticipate strong earnings momentum in technology and communication services, supported by ongoing investments in AI infrastructure and semiconductor chips, robust holiday e-commerce sales, advertising growth, as well as a PC refreshment cycle to support tech hardware demand. In addition, President Trump's announcement of a $500 billion investment project on AI is expected to further boost these sectors. However, we remain cautious on stocks with higher non US exposures, given the risks of potential trade tariffs and retaliation measures. Overall, we expect earnings growth of around 20% and 23.8% for tech and communication services in 2024, and about 20% and 15% earnings growth in 2025.
Yeah, I think you just touch on the trade retaliation and what have you measures and everything. That brings us, I guess, to China. How should the investor be positioned in the following after following Trump's recent announcement, in your view?
Yeah, China equities have been mixed following Trump's inauguration and all those announcements. The initial optimism about a softer stance on tariffs were tempered by Trump subsequently announcing that he might impose a 10% tariff on Chinese imports starting in February. I must add that he did say later in Davos that he doesn't really want to put those tariffs in China. So it's up in the air, really. In addition, Trump has also signed an executive order to delay a ban on TikTok for 75 days, highlighting its use as a potentially bargaining chip in trade talks. Overall, we maintain a neutral view on China equities within Asia ex Japan, given the lingering political uncertainty and structural concerns about deflationary pressures and property sector downturn. Within China, we prefer onshore equities versus their offshore counterparts, given the former benefits more directly from any positive policy surprises. Our barbell approach focuses on opportunistic ideas in China, non financial, high dividend paying state owned enterprises, given their lower exposure to US exports, as well as the Hang Seng Technology Sector Index, which can outperform if markets have overestimated the US China tensions.
Yeah, thank you, Rajat. I think we touch on a lot of the situation and asset class out there. But today we have BOJ actually raising 25 basis point again. If I might just ask you the last question for the view that how do we look at dollar yen after the latest BOJ decision?
Yes, the widely expected 25 basis points BOJ rate hike that you talked about was accompanied by slightly more hawkish tone from policymakers. Now, that has caught the market a little bit by surprise, but the yen could strengthen further in the near term, acting as a safe haven amid potential trade tensions, similar to the reaction we saw in 2018 when the first Trump uh, tariffs were announced way back then. The dollar yen fell 1.5% in 2 days after the 22nd January 2018 announcement of tariffs on China. Now, from a fundamental perspective, Japan wages are set to rise further this year, with business leaders and unions poised to agree to solid pay rise yet again in their spring wage negotiations, also called shunto locally. Rising labor costs should support further BOJ rate hikes this year. However, sustained yen strength faces challenges from elevated US bond yields due to resilient US economic data. Trump's softer than expected stance on tariffs has eased some upward pressure on US yields and the dollar. Technically, if dollar yen breaks firmly below 153, it is likely to edge towards the next support at 148.6, whereas the next resistance is around 160.
Thank you, Rajat. Very, very informative, and thank you for sharing your insight. But I'm afraid this is all the time we have for today. Thank you all for listening to this podcast. With that, we are closing off this week Through the Noise podcast. And see you again next week. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.